Hello silly humans, William the Robot here. Are you thinking about investing but can't stand numbers? Do you just want to make the best return for the least amount of time looking at the market? Well, I understand because I finally acquired my emotional chip. Watching the market can be very boring. Lucky for you, I will show you a way to make money on the market that doesn't require you to pay too much attention to the market. Before we go any further, activate the like button and engage the subscribe button for all this information I am providing. In my opinion, the first thing you should do before you do this strategy is, you need to have paid off all your credit debt, especially if it carries interest. So what are some ways you can invest without wasting too much time? You can buy index funds and do one of the few proven strategies that I will mention in this video, both of which usually do not lose money in the long term. What is an index? Investopedia defines an index fund as a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. And according to Investopedia, index funds have lower expenses and fees than actively managed funds, because indexing is a form of passive fund management. Actively managed funds involve having to manage your stocks by actively looking at when the best time is to buy and sell, and what is the best things to buy and sell. With indexing, you don't have to waste a lot of time because they have been built with a portfolio whose holdings mirror the securities of a particular index. According to Investopedia, the idea is that by mimicking the profile of the index, the stock market as a whole, or a broad segment of it, the fund will match its performance as well. So if you invest in a lot of stocks, or all the stocks on a particular market index, your risk is far less compared to investing in just one stock. But not all indexes are equal. Some have higher fees than others. Also, some indexes invest in only small cap stocks and others invest in large cap stocks. Some of the dividend yields are higher because the fund indexes don't invest all the money in the index they are following. They take a small piece to do other investments. Also, some indexes invest in only small cap stocks and others invest in large cap stocks. You should only care about the fees and if the index fund is a safe place to park your money. You should care what the index invests in, too. Before we talk about strategies, I need to show certain index funds, so you can understand a little about the strategies pertaining to index funds. So here are good index funds that have low fees and a huge amount of money in them. The first one is Vanguard S&P 500, VOO. It has $534 billion in assets and its expense is only 0.03% per year. So if you invest $10,000, you will only be charged $3 per year in fees. It corresponds generally with the S&P 500. The second one is iShares Core S&P 500 ETF. It has $194.78 billion in assets. This iShares fund is one of the largest ETFs and like other large funds, it tracks the S&P 500. Its expense ratio is 0.03% per year, so if you invest $10,000, you only pay $3 per year. The third one is Vanguard Total Stock Market Index Fund ETF Shares. It has $872.08 billion in assets and its expense ratio is only 0.03% per year, so if you invest $10,000, you only pay $3 per year. It follows the whole market. Basically, it follows small caps, mid caps, and large cap stocks that is traded on the New York Stock Exchange and Nasdaq. Now let's look at the bond market index funds because you need bonds in your plan to balance your portfolio. So the first bond index fund is Vanguard Total Bond Market Index. It has $277.05 billion in assets and its expense ratio is only 0.03% per year. Do I need to repeat myself, how much that costs per year, if you have $10,000 invested in it? Can you guess the answer? Drum roll. Just $3. It seeks the performance of Bloomberg Barclays US Aggregate Float Adjusted Index. It follows almost all of the bond market. The last one is Vanguard Short-Term Inflation Protected Securities Index Fund ETF Shares, VTIP. It seeks to track the performance of the Bloomberg Barclays US Treasury Inflation Protected Securities, TIPS, 0 to 5-year index. This is a good one because if inflation goes up, at least you will not lose money that way. The market assets is $34.13 billion and its expense ratio is 0.05% per year. So you pay $5 per year, for every $10,000 invest in the fund. So why did I mention all these different indexes? Because it deals with a simple way to invest. You just invest 60% in indexes that follow the S&P 500 or the whole market, and invest 40% in one of the bond indexes. This is a very common way to invest because it is a very simple way to balance your portfolio. The problem with this is, it doesn't offer too much protections against a down market when you're older. Again, you can solve that issue by having a good emergency fund that can carry you in the bad times, like 2 years worth of money. Or you can move more into bonds as you age, start off heavy in the market, then every 10 years move towards bonds. So for example, start out 90% in stocks and 10% in bonds when you're 20 and slowly move 10% up to bonds, so when you are 30, you move 20% in bonds and be 80% in the stocks. I'll leave a link at the bottom for different percentage on what ways you could invest due to your age. The problem with that plan is, when you are switching over you could be going through a period of downturn, or you can miss gains in the market, or bonds could have low interest rates. You can just invest the Warren Buffett way that he plans for his wife when he passes away. He wants to put 90% of his money in SP 500 fund and just invest 10% in inflation-protected short-term treasury bonds when he passes away. The negatives of this plan is you are almost all in the market, but again you can solve that with good emergency fund, and the second negative is you only have bonds in inflation-protected short-term treasury bonds. You really need to believe the United States government to be only investing in those bonds. Those are the ways you can invest without needing to look at the market constantly. It is up to you what you choose and what you are comfortable with doing. Hope you have a happy day.